Hey guys, it's Adrian here, the Canadian in a t-shirt, and welcome to my members only video where I'll be showing you what Canadian stocks I'm buying in my TFSA in fall 2024. I have two huge milestones in my TFSA that I'm so excited to share, and so to celebrate, I decided to make this video public and free for everyone, just like I've done a few times in the past. I want to give you a sneak peek into what my members only videos look like, and if you like this kind of content, please hit the join button down below. It really does help support my channel and I do appreciate it. In this video, I want to start off by sharing a few really cool milestones. Right off the bat, you can see this number here, my total equity is currently at $99,924. So there's a good chance that sometime within this video, my TFSA portfolio within Questrade will cross that $100,000 threshold. I am super excited and I'm expecting this any minute now. So bear with me throughout this video. I'm going to keep coming back here to see if I've crossed that $100,000 mark. And the cool thing is, a lot of this money didn't even come from me. I'll get to my TFSA performance in just a bit, but looking right here, you can already see that I'm up over $12,000, and that's just from capital gains. On top of that, I'm also earning dividends that are being reinvested every single year. And those dividends, that's the second milestone that I want to share right now. Looking here on my Excel dividend tracker, you can see that in my TFSA, I'm earning just shy of $6,000 a year in dividend income. But I have a few drips and reinvested dividends that I haven't entered yet. So I'm going to do that right now, and then you're going to see my dividend total reach above $6,000. This is my account activity. You can see all the drips I've received in my TFSA in the past few weeks. Let's start with RioCan, which I actually don't hold in Questrade. I hold that in my TD Direct Investing account. And with RioCan, I earn 4 shares every month with that monthly drip. I now have 888 shares, and as soon as I hit enter, you'll see here this dividend total is going to jump up. And boom, I just reached that milestone of $6,000 a year in dividends in my TFSA. That's $500 a month of tax-free passive income. Here's why this number is so special. The rate of growth of my portfolio is starting to exceed the rate that I can contribute. For 3 years, since 2019, the annual TFSA contribution limit was $6,000. Now it's gone up to $7,000, but still, for 3 years, that limit was $6,000. Meaning I could only put in $6,000 of my own money into the TFSA every year. And as of today, my TFSA portfolio is earning more than $6,000 a year in dividends. And so my portfolio is growing on its own faster than the money I can put in. That's amazing. And that right there is the power of exponential growth. And this rate of growth is accelerating. So it's probably only going to take me another year to get this number up to $7,000. To me, this really highlights the power of compounding and time in the market. When it comes to investing, in the short term, most of that money is going to come from you, your contributions. But if you give it time to grow and compound and accelerate, eventually the rate of growth of your investments is going to exceed the rate that you can contribute. And that's where I am today. I wasn't able to contribute $6,000 into my TFSA this year. Most of my money's been tied up in real estate, and I've been focusing on the FHSA instead. So far this year, I've only put in about $3,000 of my own money. But my investments are growing twice as fast and totally on autopilot. I put in $3,000, but my investments are creating me $6,000 a year. And if I keep this up, I'm going to get to the point very soon where most of the money in my TFSA did not come from me. It came from my investments making me money. So guys, I'm very, very excited to reach this milestone. That's why I didn't want to update my dividend tracker. I wanted to wait until I was filming this video so I could share this with you guys. Before I jump into my TFSA performance summary, I want to update the rest of my drips. And real quick, a drip is just a dividend reinvestment. So instead of receiving that dividend as cash, those dividends are automatically reinvested to buy me extra shares. And that's where all of these green rows are right here. And you can download a free template of my dividend tracker on Excel, link down below, and check out my drips explained video for a full breakdown on how drips work and what all these columns mean on this Excel sheet. So let's go back to my portfolio. Oh, and look at that. While I was talking about my dividend milestone, my TFSA portfolio just crossed the second milestone of reaching $100,000. So today is a very good day. We'll see if I can maintain these 6 digits for the rest of the video, but right now, for the first time ever, my Questrade TFSA portfolio is worth $100,000. If you remember, about a year ago in my RRSP video, I recently crossed that $100,000 threshold for the first time, and looking today, my RSP is worth almost $150,000 now. And now, for the first time ever, my TFSA has joined the $100,000 club. Oh, it just dropped down below? That's okay. In a couple of minutes, they'll probably get back. So it's really cool to share 2 of these milestones with you guys. Going back to my positions, I'm going to update all of my drips. I'm going to fast forward this very quickly. Starting with Enbridge, I earned 3 new shares, so I have 198 shares total. Also update the book value. Plaza REIT gave me 9 shares this month. H&R gave me 2 shares this month. More REITs, CRT, FCR, and PMZ, they all give me 1 drip every month. Canadian Utilities, they are a dividend king. They pay out their dividends every quarter, and I got 1 drip this quarter. Last but not least, we have Chartwell Retirement REIT, and they also pay me a monthly drip. Now this one I want to highlight. You can see here on Excel, I have a max value listed as $15. And going back to Questrade, you can see that the current live share price of Chartwell Retirement is just under $15. In addition to the great dividend yield, I'm already up over 40%, and this stock is continuing to grow. So I need to bump up this max value. That's my estimation of what's the maximum share price this stock can reach in the next couple of months. So let's bump this up to, let's say, $17 a share. And you can see as soon as I did that, the drip ratio dropped significantly to 1.04. It's still above 1, which means I will get that monthly drip, but there's not a lot of wiggle room. From this stock alone, I'm receiving $17.80 in monthly dividends. So if the share price ever exceeds $17.80, I won't get that drip anymore. Because of that, this drip is not secure. I usually want a drip ratio above 1.08. So I'm going to change this row from green to yellow, and that's just an indicator to me that I need to beef up this position. So now that I've updated all my drips, you can see that my dividend total for my TFSA is $6,023 a year in dividends. That's tax-free passive income. Before I buy my new stocks, let's talk about my TFSA performance. So right now, my TFSA account on Questrade is worth $100,000. A lot of that money didn't come from me. As we saw, I'm receiving over $6,000 a year in dividends, but on top of that, I'm also seeing great capital growth. Today alone, I'm up about 1%, that's great, and in terms of capital gains, I'm up over $12,000. If you want to see my combined total performance, we have to look at my total return. So we go to Accounts and the Trading tab, and here you can see my total return in my TFSA. This right here is what I really care about, total P&L or total returns. My portfolio is worth $100,000 right now, but I've only put in $61,000 of my own money. The rest is pure profit, $38,700. That's my investment profits from dividends over the years and capital appreciation. So I've put in 60 grand and I've earned almost 40 grand of tax-free profits. That represents a rate of return of 63%. That's what I'd love to see. And to give you a live update today while I was editing, you could see that my TFSA portfolio has done even better. It's now worth almost $105,000 with a total return above $42,000. That represents a rate of return above 68%. I love it, and I can't wait to see this portfolio grow from here. So, what am I going to be buying today? Well, I recently put in $1,500 as a contribution into my TFSA, and I received a bunch of dividends, and after all the drips went through, that left me with an extra $300. So, in total, I have about $1,800 available as cash. I don't have a lot of TFSA room left available, so I have to be strategic with my remaining room. My biggest priority with my TFSA is to maintain my existing drips. Since once my TFSA is maxed out, I'll have to wait until January to put more money in. So my focus is to make sure that all of these rows, these drips, are green. We already talked about Chartwell Retirement REIT. I just turned this row from green into yellow, and that's because the share price has gone up so much. In fact, in the past year, the share price has grown by more than 50%. So today, I'm going to put in a little bit of money into Chartwell to secure this drip. About $600 should do, and my remaining cash I'll put into a bank stock, one that I haven't touched in a while. So here we have Chartwell Retirement REIT, ticker symbol CSH.UN. They've had a fantastic year. They're already up over 50% this year. But why do I want to buy now? Zooming out, you can see here we're basically back to all-time highs, back to the levels before the pandemic. As you can imagine, retirement homes were hit particularly hard during the pandemic, but as of today, we've experienced a full recovery. I was lucky enough to time it very well. I was investing heavily at this low point during the pandemic when Chartwell was trading below $10 a share. And you can see today we're already above $15. So I've been able to benefit from great capital gains, all while collecting those inflated dividends. More on that later. Check out this video from over 4 years ago where I break down Chartwell Retirement in detail and I lay out my strategy of why I was investing at the low point back in 2020. Admittedly, it was a risk back then, but I'm happy to say my plan worked out. So, Chartwell Retirement, they are the largest senior housing, retirement home, and healthcare provider in Canada. And there's a reason why they've experienced such growth over the past year. They have some great numbers. Right now, their occupancy rate is at 87%. For REITs, occupancy rates are very important. If they don't have tenants, they don't have anyone paying rent, and therefore no revenue. And for many years, since 2022, Chartwell was hovering around an 80% occupancy rate. Now they've got 87%. That's fantastic news. They also spent a lot of money on significant acquisitions. They spent $227 million acquiring new retirement homes in British Columbia and Quebec. That's a great opportunity for growth. So I'd love to see this great capital growth over the past 12 months, but will that translate into a dividend increase this year? I don't think so. Their revenue is growing, that's good news, but they did spend a lot of money on these acquisitions, and they're continuing to spend a lot of money on interest debt on their mortgages. So I do not expect to see a dividend increase this year. Maybe next year, we'll see. But again, right now, they're still paying a solid dividend yield of 4.14%, and I'm very happy to keep it at that level, on top of the enormous capital gains that I've already enjoyed over the past 12 months. This is important. This dividend yield of 4.14%, that only applies to the stocks that I'm buying today at these peak prices. But I've been buying this stock for years at much lower values. You can see here my average price has been about $10 a share. So the actual dividend income that I've been collecting, my yield on cost, is much higher than 4%. Let's run the math real quick. So we take how much money I'm earning a year in dividends, $213, divide by how much money I put in plus reinvested dividends, my cost, 3,747, and I've got a dividend yield on cost of about 5.7%. So I've been very happy to hold on to this stock for years and collect that passive income. But because of the recent growth, I need to bump up that drip ratio. And that's what I'll do right now. So let's buy these shares. I'm going to do this really quick. I'm going to buy about $600 worth of Chartwell. So I take $605 minus $5 of commission fees, and I divide by the current share price, $15, and I can afford to buy 40 shares. Nice even number. Confirmation window, hit send order, and boom, order was filled. I bought 40 shares of Chartwell. I just bought 40 shares, so now in total I have 389 shares. So 389, as soon as I hit enter, this drip ratio will bump up. Boom, I now have a drip ratio of 1.16. That's a very safe number. That's exactly where I want to be with my drips. So I'm going to turn this from yellow into green. And with that, once again, all my drips are secure. Love it. Back to my balances, I now have $1,200 remaining as cash. I'm going to be buying another stock and an ETF. For the stock, I'm going to be buying a dividend stock that I actually haven't bought in my TFSA for a long time. I have been buying this in my margin account and corporate account, but not in my TFSA. And that stock is CIBC, ticker symbol CM.TO. This is another stock that's been doing very well over the past year. Just look at the graph. That's what I love to see. CIBC is one of the top 5 biggest banks in Canada, and in the past few weeks, all of the big banks had their recent Q3 earnings released, and it was definitely a mixed bag. Most of the banks had some pretty disappointing results, but CIBC actually exceeded expectations with some really good results. CIBC saw nice growth in their personal banking sector, which is actually their biggest chunk of their revenue stream. It accounts for about 40% of their revenue, so that's great news. And this is interesting. Compared to the other banks, CIBC actually reduced their provisions for credit loss. What that means is how much money they set aside as an expected loss due to credit default. So when people take out loans or mortgages and they simply cannot pay it back, that's revenue lost for the bank. Over the past year, with these high interest rates, all of the banks have been increasing their provisions for credit loss, meaning they're setting aside more money for these expected losses. However, CIBC reduced this money they're setting aside. That's interesting. With interest rates coming down, this to me indicates that CIBC expects that credit defaults will no longer be much of an issue. They expect their customers to once again pay back their loans as expected. And now that they don't have to set aside as much money for these credit losses, they have more money to reinvest, grow the company, increase their dividends, and ultimately return more value to us, the investors. On the books, provisions for credit loss are treated as an expense. So this quarter was good news on two fronts. One, their revenue increased, that's always good news. And two, they're setting aside less money, and so their expenses have decreased. And so we saw a significant boost to their overall net income. This quarter, their net income grew by over 27% more than last year. That's fantastic. And that's why we've seen such a pronounced increase in their share price over the past few weeks. Great news. We mentioned the boost to CIBC's personal banking side of things. And note, CIBC also owns Simply Financial, one of the best online digital banks in Canada. Simply Financial offers some of my favorite credit cards, no-fee checking accounts, savings accounts, and mortgage products. So as Simply Financial grows, CIBC benefits from that. So not only are we seeing fantastic capital appreciation with CIBC, looking at my positions, my holdings are up almost 60%, love it. They've grown so much and they're basically back to all-time highs. The previous peak was back in 2022. That's when interest rates started shooting up and the financial sector took a hit. But now we're back and fully recovered. And even with this great growth in their share price, they're still paying a fantastic dividend with a yield of about 4.5% right now. Not only is this a high dividend, it's a very sustainable one. They currently have a dividend payout ratio of only 52%. So only about half of their profits go out as dividends, leaving another half of their earnings to reinvest and grow as a company. That's fantastic news. I'm happy with their dividend right now, but I expect it to increase even higher. CIBC has increased their dividend every year for the past decade. The last time they increased their dividend was December of 2023, so I am almost certain that they'll boost their dividend before the end of the year, likely again in December. I'm very happy to be buying this stock today, and looking here, I'm actually buying the stock before the ex-dividend, so I will be locking in these new dividends. Click buy and sell. You can see my available cash. I have about $1,200 left. I'll be putting in another $600 right now. So take 605 minus $5 commission fees, and we divide by the current share price, 81.92. So I can afford 7.3 shares, but seeing as I have extra cash available, let's round it up to 8 shares. So 8 shares, it'll cost me about $650, send order, and boom, order was filled. I bought 8 shares of CIBC. So now I have about $557 remaining in cash. I'm going to be buying one of my favorite ETFs, and that's this one right here, VDY. VDY is a Vanguard ETF that focuses on high dividend payers in Canada. So they look at the biggest companies in Canada and they choose 56 of those highest dividends. I break down VDY in detail in this video here on my favorite Canadian ETFs. VDY pays out a monthly dividend with a yield of about 4.5%, and they've also seen great capital growth over the past year. The reason for this is that about half of this ETF is made up of the financial sector. So those are the big banks and insurance companies. These companies have been doing really well since interest rates have started to come down. And so the ETF as a whole grows in value. In fact, CIBC makes up about 5% of this fund. So today I'm double dipping in CIBC in 2 ways. So I'll spend my remaining cash, $557. With Questrade, when I'm buying ETFs, I don't pay any commission fees, so I don't have to take away $5 this time. I just divide by the current share price, 47.19, and rounding down, I can afford to buy 11 shares today. So 11 shares, click send order, and boom, I bought 11 shares of VDY. So I've spent all of my cash for today, and you can see my TFSA portfolio just dropped under $100,000 again, but that's okay. Hopefully in a day or two, I'll reach the 6-figure mark once again. Last step is just to update my Excel dividend tracker. I already updated my Chartwell Retirement REIT. Now I have to update my CIBC stock. I bought 8 more shares. Now I have 26 shares of CIBC. New book value of $1,597. That's how much money I put in plus reinvested dividends. And notice here, since today I basically doubled my book value into CIBC, my profit and loss has significantly dropped. Before I was at a profit of 56%, now it's dropped down to 33%, which makes sense. Remember, I bought those shares many years ago at a much lower price. Now today I bought them at all-time highs, so my average cost went up and thus my overall profit as a percentage went down. Now I resort my stocks by book value. Chartwell always used to be my smallest REIT, and after today, it just passed Primaris REIT. I also have to update my ETFs with VDY. I now have 98 shares of VDY. Book value is now $3,671. So after today's investments, my annual dividend total in my TFSA account is now $6,125. That's $125 more just from today. So that's it for today. I hope you guys found this video helpful. And as always, thank you guys so much for supporting me through this membership program. It really makes a big difference for me as a full-time YouTuber. This members only program is by far my most consistent stream of income. So I truly do appreciate it. If you're not a member and you want to see more content like this, hit the join button down below. I've been running this program for over 4 years and I've never increased the price. And I hope I never have to. I've already set aside some money for my FHSA, my first home savings account, and a bit of money for my TFSA later this month. So I hope in October I can make 2 members only videos for you guys. And as always, if you want to get started investing with either Questrade or Wealthsimple, I'll include my referral links down below to get a nice sign-up bonus. So thanks for watching, and I'll see you guys on the next episode of The Canadian in a T-Shirt. Bye, guys.